The broadcast is now starting. All attendees are in listen-only mode.
Hello, good morning, good afternoon, good evening, depending on what part of the world you're in. Welcome to the Wilkin Gutton Plan webinar, one of our many series of webinars on the various coronavirus provisions that are coming up in the U.S. tax code, most notably the CARES Act. Today we're going to talk about the business aspects of the CARES Act, with really a special focus on the implications for foreign-owned U.S. corporations. So we're going to talk about U.S. Businesses that have been impacted by the coronavirus and really focusing on what are the special nuances if the corporation is foreign-owned. With me today, my name is Vinay Navani. I'm a tax partner at Wilkin & Gutton Plan. I'm going to be the moderator. Three of my colleagues will be part of this webinar. Karen Arta Sanchez is a tax partner who does a lot of work in international and corporate tax. Bill McDivitt is our director of tax. Bill has really immersed himself in the world of the various loan programs that are part of the CARES Act, and he's going to be speaking about those. And Darko Namowski is a tax manager, works very closely with me on the international clients, so we'll all be speaking about different parts of the CARES Act today. So here is just kind of an agenda. We're going to talk about the economic stimulus programs, the tax deadlines, before the CARES Act, there was the Family First Coronavirus Response Act, the Employee Retention Credit, the Payroll Tax Deferral, net operating loss rules, interest expense limitations, some depreciation provisions, and hopefully if we have time, we'll get to go through and answer some questions. Speaking of questions, there is a chat feature. You can send questions to us. We will try our best to answer them during the webinar. And if we can't do that, we'll respond back via email to you. The CARES Act and the guidance that has been coming out from the Treasury and the Small Business Administration and the Internal Revenue Service has literally been coming out every day. So this guidance is a moving target. We've really kind of frozen this guidance as of last Friday. So that's why if you're listening to this webinar online and listen to it afterwards, you're going to see some of the information may be different. So keep that in mind. After the webinar, the recorded version of this will be on our website at www.wgcpas.com. So with that, let's start talking about the economic stimulus packages. And, you know, Bill, everybody's talking about PPP or Paycheck Protection Program. That's kind of like a loan, kind of like a grant. So, Bill, do you want to jump in and start talking about the Payroll Protection Program?
Sure. Thank you, Vinay. Hello to everyone. Just wanted to give you a little bit of background on the Paycheck Protection Program. In light of the fact that we've got a lot of tax issues to cover, we're just going to address this from a high level. If you need any more granular information, we'd be happy to help you and follow up on this. The Paycheck Protection Program was part of the CARES Act. We often refer to the Paycheck Protection Program as either PPP or P3. In case I use that later, you'll understand what I'm referring to. This program is run via the SBA, which is the Small Business Administration. And initially, it was brought out in the CARES Act with funding of just short of $350 billion. The loans were guaranteed by the Small Business Administration. Those funds went in about a week. So the program was exhausted. And recently, Congress and the President signed a new round of funding authorizing up to $310 billion of additional guaranteed Small Business Administration loans. This $310 billion second round of funding is active right now. There's about half of it that's been used, to my understanding, so far, so the program is still open and applications are still being taken. We'll talk about this slightly more in the future part of this broadcast, but these loans are applied for at banks and other lending institutions as opposed to directly with the Small Business Administration. They're designed for small and medium-sized businesses, and they can receive up to $10 million in lending. And all the loan proceeds have the potential of being forgiven, which effectively converts the loan into a grant. And we'll talk about that in a little more detail as we go along. There are no requirements for personal guarantees or collateral that's required. And that's an important issue for many borrowers. And the Small Business Administration, generally speaking, has a requirement that in order to get a loan facilitated by them, that you have to have attempted to obtain credit elsewhere and not been successful. For this program, for the Paycheck Protection Program, that obtaining credit elsewhere requirement has been waived. And as I mentioned earlier, the loans are issued by banks that are either SBA approved or have been approved for this process. So how do you get a loan and how do you qualify and what amount of a loan is available to you? The basics of this program are you have to calculate average monthly payroll. And generally speaking, we're looking back at calendar 2019 to determine what our payroll costs are, which is really a broad range of items, not just wages. You can see the key elements are highlighted in green below. I won't deal with each and every element, but I'll just deal with the main factors that are highlighted in green below. So you start with, in order to determine what your payroll costs are, you start with gross salary paid to employees. And in addition,
Hey, Bill, something's happened to your audio.
my audio? Something, not here. It's not on my end. There you go. I think someone had a meeting.
Okay, I think it's fixed now. Yep, okay, there we go.
Sorry about that little technical glitch. So you start with gross wages or salaries paid to employees. In addition, many companies in the United States use a contract employment agency to effectively provide them with workforce. We refer to those contract employment agencies as PEOs or employee leasing. Those employees that are not directly employed by the company but are indirectly employed by the PEO or employee leasing also qualify, as do temporary staff. So again, we're starting with gross salaries as the initial amount to determine payroll costs. We add to that the employer portion of expenses incurred in connection with group healthcare benefits, which is principally in the U.S. Health insurance premiums. There could be other elements that are included in there, but it's principally health insurance premiums. We also add to that the employer portion of any retirement benefits that are provided. And last but not least, we add the employer portion of state and local employer taxes that is assessed on the compensation of the employees. But as a key note here, we do not add back the employer portion of federal employer payroll taxes. So that in the aggregate becomes what we call payroll costs. Again, we look back at calendar 2019 to determine the annual payroll costs, divide that number by 12, and we get to the monthly payroll costs. Slide forward, please. Okay, so what amount of a loan do you qualify for? You basically take your average total monthly payroll costs incurred during the prior years we've just discussed, and you multiply that by 2.5, 2.5 times the average monthly payroll costs, and that becomes the amount you qualify for a loan, unless that amount is in excess of 10 million, at which point in time the loan is capped at 10 million. So the simple basics are calendar year average monthly payroll cost times 2.5 times, and that's what you qualify for a loan. Okay, this is really the key part of this program, the ability to have the loan forgiven and effectively turned into a grant. This aspect of this program has made these funds highly sought after. There's been the Small Business Administration also made this a first come, first serve program. So folks have been, businesses have been very active in trying to get their loans processed and received. Once the loans are processed and received and the funds are in the hands of the businesses, they have an 8-week period to use the funds in a qualified way so that they qualify for loan forgiveness. Again, here I've highlighted the key terms in green so that we can focus in on exactly what are the key elements that can be used to get loan forgiveness. The first element is payroll costs. Again, it's not just salaries, it's all of the items that we discussed earlier when we discussed payroll costs. So it would be, in this case again, it would be gross salaries plus the employer portion of any healthcare expenditures, plus the employer portion of any retirement benefits, and last plus the employer portion of state and local employment taxes. And these payroll costs must equal at least 75% of the amount of the loan that's forgiven. The primary purpose of the payroll protection program was to keep people off unemployment and keep them employed and facilitate a bridge for businesses from our shutdown period to hopefully a period during which businesses will be able to be active again and give them a bridge financially to get to that period when they can be active again. The other things that the money can be spent on during this 8-week period is rent, and that would be facility rent where the businesses are operated. In addition, utility payments, which are fairly broad, can be also qualified during the 8-week period. They specifically indicate that electricity, gas, water, transportation, telephone or internet access is all qualified under the concept of utility payments. And last but not least, interest expense, only interest expense, not principal, would be covered for certain mortgages that were incurred prior to February 15th. There are two other potential hurdles you have to get over for loan forgiveness. One is, and we're not going to get into this in much detail, but I'll just mention it. One is you need to maintain the number of employees that you had during the pre-pandemic period. And number two is you need to maintain the levels of their salaries. These two requirements could potentially cause the loan forgiveness to be reduced if you do not meet the standards of maintaining the numbers of employees and the level of their compensation. The last thing I'll mention on loan forgiveness is that loan forgiveness application is made to the bank from whom you got the loan, and you make a submission to the bank after your 8-week period is over, and the bank, not the Small Business Administration, is the party that will determine whether your loan is forgiven or not, which is a bit of an unusual setup, and it's the first time anything like this has ever happened before. So we'll see how that rolls out. And I said this was the last thing I'd mention on loan forgiveness, but I'll mention one other thing. We expect some extensive guidance to be issued on loan forgiveness. The law required that the guidance was supposed to be issued within 30 days of enactment. 30 days of enactment was a week ago last Sunday, so about 8-9 days ago. That loan forgiveness guidance has yet to come out. There is an expectation that the loan forgiveness will be extensive. Sorry about that. Will be extensive and may provide some user-friendly elements for businesses, and that's part of the reason why it's coming out slower than it has been expected. Let's move on. So that concludes the Paycheck Protection Program discussion, which has been the most sought-after program. The second most
Bill, before we get into EIDL, if you don't mind, let's just talk about PPP for another minute or two.
Sure.
one thing that you may have said, but I don't remember hearing, was just a clarification. When we talk about payroll, both in terms of the application and the usage, there is a limitation of up to $100,000 per person on a monthly basis. So
that's correct. Thank you for.
So a lot of, yep.
Yeah, thank you for pointing.
And I'm sorry. Go ahead, Bill.
I was going to say, this was originally misunderstood in the provisions. If someone makes in excess of $100,000, the provision provides that you only count their payroll up to $100,000, meaning when I say payroll, I mean the salary, but you can add the health insurance and retirement benefits and state and local taxes so that employee effectively would have $100,000 of salary plus those other three elements. So that $100,000 cap on salary applies, as Vinay just mentioned, on both the calculation of the average monthly payroll amount as well as the loan forgiveness.
Good, thank you. I guess just to share with the audience some of the experience we had with clients that are foreign owned, there was quite a bit of confusion as to whether foreign owned clients qualify for this loan. And part of the confusion was based on the fact that the PPP loan is part of the Small Business Administration program. So it's not part of the tax code, and it's really somewhat disjointed from the other Small Business Administration loan programs. And when you look at the form that came out, one of the questions on the form was, list all the 20% or more owners and input their Social Security number or U.S. employer identification number, which are both, indications of U.S. tax status. And as Bill said, these loans are really, even though they were under the purview of the Small Business Administration, they were actually issued by the banks. Some banks took the position that was a required input, so that if your owner was not a U.S. taxpayer or U.S. corporate or individual resident, that the business didn't qualify for the PPP loan. I think we've gotten to the point where we feel that that's not the case. As long as you're a U.S., there's been enough guidance issued that if you're a U.S.-based company and the wages are based on U.S.-based services and employees, that those salaries do count towards the PPP loan. There was quite a bit of confusion about this in the beginning, and with some banks there still are. So just keep that in mind. That's just more of a comment than anything else. And just the last point before we leave the PPP topic, Bill, there's been a lot of discussion just in the last few days about the some high-profile public companies that got PPP loans, and you want to just talk about some of the guidance that's come out in the last few days about the additional test for qualification for a PPP loan?
Yeah. So as Vinay mentioned in his intro to the entire program, there's literally changes that come out on a daily basis, and we are looking several times a day at the website that is updated to provide this additional input. But one of the items that came out in a section they call frequently asked questions, question number 31, which came out about a week ago, was in response to some negative publicity that was received when a number of public companies effectively qualified for some significant PPP loan, and a couple of the names were Shake Shack, as I recall, and I believe Ruth Chris Steaks was also in there. These companies qualified because there was a specific exemption from the attribution rules for numbers of employees in the hospitality businesses. Hospitality businesses only had to look at an employment site by employment site to determine whether they had 500 or more employees. So if you're running a restaurant business in a public setting, you probably have any number of your corporate-owned sites that would qualify. This rubbed the politicians and the public at large negatively. This program was envisioned to help small businesses survive, and when it became known that public companies were receiving benefit and obtaining loans through this program, there was a reaction that was not positive, and question 31 arose. Without reading question 31, it basically warned folks to consider whether or not they qualified to receive this loan, because did they in fact need the loan, which is part of the certification that you have to make to obtain the loan. And basically the question it states that if you had a publicly traded company that had a significant market value and access to capital markets, that you do not qualify for this loan. This concern about publicly traded companies has bled to private companies as well. So there's additional concern as private companies that are well financed and well funded consider applying for these loans as to whether or not they effectively qualify. And it's really a ball that's in the air, or a question that's still not completely answered. It's very vague.
Yeah, we could have an entire webinar just on that topic of FAQ 31 at this point. So that is something to consider if you have received funds. It's really a separate subject. Let's move on quickly to just some of the other lending programs. And you want to start out with take it from here, Bill?
Yep. Okay. So the other program that was available when the initial launch came out on the Paycheck Protection Program was something called an Economic Injury Disaster Loan. We use the acronym EIDL to speak of this topic. The EIDL program you apply for directly at the Small Business Administration's website. In addition to the loan, you could qualify for a grant of up to $10,000. So a lot of businesses went to make applications for the EIDL loans in addition to the paycheck protection loans. The problem is that because these were administered directly at the SBA, the SBA was inundated with P3 loans, and they really didn't have the resources to deploy to execute on the EIDL loans. And so there were significant delays when these applications were made. The second issue is that this program was not as well funded as the Paycheck Protection Program, and initially ran out of funds very, very quickly. And with the legislation that introduced the second round of Paycheck Protection Program funds, there was also a second round of EIDL funds, which were $10 billion, which is a small fraction of what's available on the Paycheck Protection Program. And as of today, you cannot apply for an EIDL loan unless you're an agricultural business. So that this may not be of much interest to the group listening. If someone happens to be connected to an agricultural business, you can reach out to us and we can discuss this with you in more detail. And the last program, the newest program that has come up, is a program that has been introduced by the Federal Reserve. This is a different U.S. government body than the Small Business Administration. And they have introduced and launched a program called the Main Street Lending Program. Basically, this program was designed to help businesses that had over 500 employees, which was the cap for the Paycheck Protection Program. It allows you to have up to 15,000 employees and up to $5 billion in revenue. The main difference between a Main Street loan and the Paycheck Protection Program loan is that the Main Street loans are not forgivable. They are, in fact, real loans that need to be paid back with interest over time. These loans are underwritten at the banks, so you go through normal underwriting processes. And there's another group of restrictions that you must self-impose on yourself if you take a Main Street loan. One is that you cannot do any stock repurchases. The second is that there are restrictions on dividends. And last but not least, there are restrictions on compensation for highly compensated employees. These restrictions apply during the period that the loan's outstanding and for a year after the loan has been repaid. So the next slide, this is laying out for folks, and I believe these slide decks will be available, so I'm not going to go through every element on here. It's a bit of a crowded slide. As I understand it, this slide deck will be available for you folks to obtain after this session. Basically, the minimum loan is $500,000. The rate is LIBOR plus 3%, and it's generally speaking a 4-year loan, with the first year being an automatic deferral. You don't pay anything during the first year. There are 2 categories mainly. The heading here at the top line says new loans and priority loans. The difference between these two is one caps your ability to borrow at 4 times 2019 EBITDA, and the other caps your ability to borrow at 6 times EBITDA. The difference also, which is not indicated on the slide, is that the banks on the priority loans receive 15% of the risk on these loans, while the banks on the new loans that are capped at 4 times EBITDA only have a 5% risk on the loans. So the banks are in all likelihood going to be much more carefully looking at the underwriting of the priority loans in the situation. So the last slide I have for you, and again, this is useful when you get the slide deck, these are actually links that can bring you to the Small Business Administration, where you can check out the programs that run through their platform, which is the EIDL loans and the Paycheck protection loans. The U.S. Department of Treasury has the main resource for where the Paycheck protection loan guidance is contained. And last but not least, the Federal Reserve site has the information in detail on the Main Street Protection Program. If we moved over those 3 topics pretty quickly, and if anyone has any questions, feel free to reach out to us and we'll be happy to help.
Bill, thank you. Those stimulus loan packages are probably some of the biggest pieces of the CARES legislation to help businesses get back on track, so that was very helpful. Now we're going to go into more of just the conventional tax provisions of the CARES Act. And before we actually get into that, I'm going to talk for a minute about the tax filing relief. So in the U.S., typically for individuals or corporations, a tax return or extension is due by the 15th day of the 4th month after year end. So for a calendar year company or individual, the tax filing deadline is April 15th. For a March year end, for example, it would be July 15th. We have quarterly advanced tax payments that are based on the 4 quarters that you see listed on the screen. Generally, when you file a tax by the due date of the tax return, the April 15th deadline, even if you're not filing the tax return, you have to pay the estimated tax that's due at the return. In the event that you don't file a tax return at that time, if you request an extension, if you wait and pay the tax with the extended due date after April 15th, there will be penalties and interest. And in the US, we have 50 states. All those states have their own tax system. Most of them try to conform to the federal calendar, but not all of them do. So you have to keep mindful of state taxes. So what is the relief that's been given? The most recent relief came out on April 9th, 2020, and that was Notice 2020-23. There were earlier versions of this relief that were more limited, so you want to make sure that you're looking at the most current one, the above notice, which is the most broad. And basically the overall theme is that any tax returns or payments that were due on or after April 15th have been postponed to July 15th, 2020. So everyone received this, for the most part, everybody received this 3-month deferral because of all the interruptions due to the COVID-19 virus. At the federal level, and let me just get here, at the federal level, 2 types of taxes generally were not included: payroll taxes that we're going to talk about in a minute, and various excise taxes that are more specialized based on particular industries. At a federal level, we're not granted this relief. So for those types of taxes, for the most part, you're under your typical tax filing deadlines. Going back a slide, just to note, because the primary tax deadline in the U.S. got shifted from April 15th to July 15th, many corporate and individual taxpayers will have basically 3 tax deadlines rolled into one on July 15th. They'll have their 2019 tax filing, tax return or extension due, along with any payment due for 2019. They'll owe their Q1 estimated tax payment, which would have been due April 15th. And they will owe their Q2 2020 estimated tax payment, which would have been due June 15th. So the good news is that's a welcome deferral, and with 2020 not being, for most businesses, not being as profitable as 2019, we really are midway into the year to really fine tune what those 2020 estimated tax payments should be. The bad news is that, is 3 payments rolled into one. So that could be a significant amount of money. So businesses need to plan for that cash flow need for July 15th, 2020. The other important thing to notice is there was a revenue procedure 2018-50, which talks about various tax time-sensitive actions that are automatically extended in the event of a federal disaster. Things like if you're changing your year end, the deadline for filing the application, if you're changing your accounting method, if you're obtaining an IRS private letter ruling. There's a long list of very time-specific things that are specifically listed that are extended due to the coronavirus relief. So I would have you check that if there's something unusual you're doing in your 2019 or 2020 tax filings. Also, if you are filing a refund claim, meaning that we generally have 3 years from the date you file a return to amend it, that has been extended as well. And filing certain petitions in the tax court have been extended as well for the same window. So check those specifically. How do you take advantage of this relief? You just basically, it's automatic. As long as you qualify, as long as it's not a payroll tax or an excise tax, generally if something was due on April 15th, it's now been pushed to July 15th. And if you had an extension that you wanted to file by April 15th, you now have to file it by July 15th. So with that, now let's really get to a concept that most of our listeners from outside the U.S. will know, permanent establishment. And now Darko is going to talk about how that has been impacted by the recent IRS guidance.
Thanks, Vinay. And Vinay, before we get into the permanent establishment rules, hi everybody, by the way. A quick question back to in terms of the extension period. In the extension period, extended everything to July 15th, but what if my corporate year end in the US is March 31st? What happens then?
So March 31st would be due July 15th. So you're basically under, that's a great question. That's really, you're based back to the normal rules for the most part. As of this point, our relief is through July 15th. So it's really business as usual for a March year end in terms of their tax filing deadline. Okay.
Excellent. Thank you. So hi, everybody. I just wanted to quickly touch base on permanent establishment rules and the relief that we have under the new guidelines. Generally, when we have a foreign corporation performing services in the U.S., it triggers U.S. source or U.S. taxable income for which that corporation needs to remit and pay tax. That under the treaty rules, if that's the only income that the corporation has, that may be avoided and no tax would be due. However, under the new travel disruptions that people may have had, some foreign corporations that send people in the U.S. on a temporary basis may have gotten stuck in the U.S. and therefore exceeded the number of days they can be present in the U.S. and in doing so created some U.S. source income for their corporation that is operating overseas. Because of that, the government has provided relief to exclude up to 60 days of one or two or many employees of that foreign corporation from counting them as U.S. days and counting them as income earned in the U.S. So what generally the IRS has said is, in order to take advantage of this, foreign corporations should be filing protective Form 1120-F to make sure they don't get caught in the U.S. tax system or pay more tax than they should. So that's kind of the overview of that. Go ahead, Vinay.
So that's kind of the business side. Now, I believe there was also a similar guidance for individuals who are in the U.S. who are not U.S. Permanent residents and citizens who have to count their days. Can you talk about that for a second?
Yeah. So correct. So basically taking the same premise that an individual that is working for a foreign corporation in a foreign country comes to the U.S. for business travel, and within 2 weeks they leave. However, due to COVID-19, they're stuck and they can't travel back home. That person, because they're staying in the U.S., may have U.S. presence, and they may be earning some wages or income in the U.S. under U.S. tax law, and may be liable for tax because of that. Under these provisions, that person can exclude counting up to 60 days of presence in the U.S. and wages earned or income earned in the U.S. And this also applies to the people that are very familiar with the substantial presence tests, that they can also exclude up to 60 days in terms of counting days towards a substantial presence test. The period which you can use to exclude days have to start between February 1 and April 1 of 2020. So there's a 2-month period when the 60 days can start, and then they can end within the 60 quote unquote calendar days, not business days, but calendar days. So I hope that covered that question, Renee.
Yeah, I mean, we have many clients who are not from the U.S. who count their days and are very careful about maintaining their day count. So a shift a few days here or there due to a delayed flight could make a difference. So that is relevant. So Darko, since we're talking, Karen's going to talk about some of the employment-based credits, but I think to understand that you have to have a basic knowledge or understanding of how the U.S. payroll tax system works. So do you want to spend a minute talking about that, Darko?
Yeah, I'll try to be quick about this because most people are very familiar with these employee and employer-based taxes in the U.S., but basically the way our tax system works is anybody that earns wages in the U.S. is subject to our Social Security and Medicare tax. Our Social Security is the retirement plan, the government-sponsored retirement plan, and on each dollar of wages up to $137,700, the employee pays 6.2% to the government, and so does the employer. There's a matching principle. In addition to that, our Medicare tax system is really our old age retirement insurance program. And on each dollar earned without a limit, there's a $1.45% paid by the employee, and the same percentage is paid by the employer with no limit. Both of these taxes are generally collected or have to be collected at the time that the wages are being paid out to the employee by the company, and usually there's a big portion of this is done by the payroll companies that administer wages and help companies do this. In addition, there's one small little thing that we haven't, one additional tax that we haven't added on the slide is that there's an additional 0.09% tax on wages over $200,000 that factor in as well down the road for earners that make in excess of $200,000.
Good. Thank you, Darko. And I had noticed that the IRS just revised the quarterly payroll tax return Form 941 to take advantage of some of the credits that Karen's going to talk about. But that will be part of the payroll tax filings that's often done by the payroll tax company for the business. So with that, Karen is going to talk about a piece of legislation that came out a few weeks before the CARES Act, Family First Corona Response Act. Karen?
Yep. Hi. Good morning, everybody, or good evening, wherever you are. So as Vinay mentioned, and as Darko kind of teed up this part of the discussion, the Families First Coronavirus Relief Act was signed by President Trump on March 18th. So this was really the first piece of legislation that impacted employers and individual workers that are impacted by this coronavirus. And the basic gist of the legislation was that it required small and mid-sized businesses to make payments, either sick pay or family leave pay, depending on the circumstance, which we're going to talk about in a second. And these payments were mandatory. So businesses who had less than 500 employees, as I said, are required to make these payments to their employees. There were two circumstances where these payments were required. One of them, we'll talk about them, the details, but one was a direct impact and one was a caregiver impact. And the difference is that, you know, businesses that had employees that were directly impacted, meaning they were sick themselves or they couldn't go to work because their place of business had closed, that's the direct impact. And the caregiver impact is an employee who could not work because they needed to stay home and take care of someone who was sick, you know, with the coronavirus, or who had a child who couldn't go to school anymore because their school was closed. So if you keep in mind, and I think, you know, Bill had mentioned this earlier when he was speaking, you know, one of the goals of these programs was to get money into the hands of, you know, the employees. Businesses were closing, you know, people were not getting their paychecks and things like that. And as a means to try and keep people off of unemployment and you know, prevent the state unemployment systems from being overburdened, these programs were implemented, and the burden of payment, you know, to get money into the hands of the employees was actually shifted to the employers. So because this was a mandatory payment, in order to make the businesses whole, the FFCRA implemented these payroll tax credits. So employers required to make these payments were entitled to refundable payroll tax credits to offset, you know, the cost of the paid leave. So the credit is equal to the sum of the qualified sick leave wages plus family leave wages plus healthcare, you know, premiums that were paid, and the employer's share of Medicare tax. So depending on the circumstance, you know, whether you were making the sick leave payments or the family leave payments, that determines the amount of the credit that you're entitled to. So an individual who was homesick, you know, themselves were sick, so this direct impact, they were required to be paid a maximum of $511 a day for 80 hours over 2 weeks. So it's basically 10 days of pay. So that turns into a $5,110 maximum credit to the employer making these payments. For the caregivers, it was a $200 maximum per day payment over 2 week period, so $2,000. So that's the sick leave component, and that's a 2 week max payment requirement. The family leave was a little different, and again, the only time that these family leave payments kicked in was if you had to stay home to care for a child who couldn't attend school. So that carries with it a $200 a day wage payment for 10 weeks. So there's $10,000 maximum credit that's available. And as I said, the healthcare premiums and the employer's share of the Medicare tax. So that's the maximum amount of credit that's available. The wages, the period to which this credit applies is for wage payments that were made starting April 1st through the end of the year. So employers, would take those payments, add them all up, and that's the amount of the credit that they would be entitled to. So how do you claim the credit? So Vinay mentioned this Form 941. So we file, quarterly federal payroll tax returns using this Form 941. And because the credit is allowed against the employer portion of Social Security taxes, so as Darko mentioned, wage payments carry with it, two components of the Social Security tax, the employer piece and the employee piece. This FFCRA credit is available to offset the employer portion of Social Security taxes. If the credit, again, which is tied back to the amount of wages, that the employer is required to pay, if that credit amount exceeds the employer portion of Social Security taxes that are reported on the quarterly tax return, that excess can be refunded. So basically, the employer is going to be made whole for the cash out of its, out of pocket to pay the employers. Further, if you know that you're going to have additional payments, you can retain your cash by reducing the amount of taxes that you would otherwise be required to deposit for that quarter. So we didn't talk about this, but there's still withholding that has to be done, from the employer's wages and other types of taxes, the employee's piece of the Social Security tax. So as an employer, if you're making these FFCRA payments, you can actually manage your cash flow by holding onto your cash. And the reason that the Form 941 was revised was to take into account, all of these different components of the payroll taxes and make sure that everything is being accounted for properly. And a lot of companies, there's not many companies in the U.S. are doing their own payroll reporting. Everybody is generally using third-party payroll providers. So those payroll providers, they need to know what type of payments you're making. So you're going to have to coordinate with your payroll company to make sure that everything is accounted for properly and that the forms get filled out and that wage payments are actually classified appropriately.
Thanks, Karen. And just one real-world example, we had a client who has a manufacturing facility. They had 1 or 2 cases of COVID. They shut down the line for cleaning, and they continue to pay the employees. And
right.
We looked to see whether FFCRA would apply, and it didn't, because one of the requirements of FFCRA is that the employer is otherwise open, and the individual who is being paid is not working because they are either sick or taking care of somebody who's sick.
Right.
So that's the situation where the business is open. So now we're going to talk about the employee retention credit, which is relevant in some cases if the business is closed. So Karen, can you tell us about this credit?
Sure. So this is similar in that it is a tax credit against payroll taxes. It provides a refundable payroll tax credit to employers that's equal to 50% of wages paid by eligible employers, during the COVID-19 crisis. So who's an eligible employer? So an eligible employer is a business, that a company who's carrying on a trade or business during calendar year 2020. This includes tax-exempt organizations. In order to qualify, you either have to be fully or partially closed, which we can talk about in a second, or you must have experienced a significant decline in gross receipts during a calendar quarter, which we're going to talk about. The biggest caveat with this is that if you received a PPP loan, that Bill spoke about earlier, you are not eligible for this payroll tax credit. So we talked, what's a partial suspension? So the government, has restricted operations for a lot of businesses, but, some businesses aren't necessarily closed. So, there's a very gray area as to what constitutes partial suspension or suspension. An accounting firm, as an example, we're prohibited from physically going into our office, but we're still operating. A pizza place or a restaurant, as an example, is closed, by government mandate, but they're still allowed to operate and serve the public through carryout, drive-through, delivery, things like that. So, there's not a whole lot of clarity as to what constitutes partial suspension. But businesses that are partially suspended or fully suspended are eligible to claim this benefit. You can switch, Vinay, that's fine. The other qualification is that if you've experienced a significant decline in gross receipts. So you're going to compare a calendar quarter in 2020 to that same calendar quarter in the preceding year. And if your gross receipts are less than 50% of the prior year same quarter, at that point in time, that's a triggering event where you become eligible for this credit. And you continue to be eligible for the benefit until such time as you have restored 80% of your gross receipts, again, relative to that same quarter in the preceding year. So what wages qualify for this credit? So for purposes of this credit, you're looking at wages that were paid after March 12th and before January 21st. Also includes health insurance premiums and health benefits. It's capped at $10,000 per employee for all quarters. So there's a maximum of $5,000 per employee credit. What wages do you include? That really depends on whether or not you have more than 100 full-time employees or less than 100 full-time employees. And you're looking back at 2019. So if you had in 2019 more than 100 full-time employees, for purposes of computing this employer retention credit, you only include wages paid to employees who you furloughed or who have had their hours reduced. If you had less than 100 full-time employees, you can include all of your wages. And while you are eligible for both the FFCRA credit and the employer retention credit, you cannot claim the credit for the same wages. And again, just to touch quickly upon this, these credits are going to be claimed on Form 941 with the payroll tax returns. There is a form that came out to actually request an advance payment of a credit, which is Form 7200. So again, you should be coordinating, the claiming of these credits with your third-party payroll company.
And Karen, just to make a comment, when the CARES Act was first passed, there was such a focus on PPP that a lot of people, once they saw that you can't get this credit if you take a PPP loan, there really was very little attention put on this. Now that we're kind of at the end of the PPP cycle, many, especially foreign-owned businesses, had problems getting their PPP loan. Many people are taking a fresh look at this credit that weren't looking at it before, depending on where they ended up on the PPP spectrum.
Correct. And I think the key here is just, looking at the wage payments that you're making and understanding the circumstances under which those payments are being made to maximize the credits that you're entitled to.
Great, thank you. There's also a similar benefit for payroll tax deferral. Do you want to talk about that for a minute, Karen?
Yep. So we'll go, just trying to be respectful of everybody's time. We'll go through this pretty quickly. Another benefit, again, trying to keep money in businesses' hands. Eligible employers are able to defer payment of the employer portion of Social Security tax. So this basically means for any taxes, when you file the quarterly payroll tax returns that were required to be remitted starting with March 27th and ending before, through the end of 2020, you're allowed to defer. So to the extent that you defer payment of the employer portion of Social Security tax, the remittance, again, this is a deferral, it's not a permanent benefit, half of what you defer has to be paid by December 31st, 2021, and the other half has to be paid by December 31st, 2022. So it's a pretty, long, deferral period. The caveat with this is that once you receive notification that all or part of your PPP loan has been forgiven, you are no longer eligible to defer the remittance of these payroll taxes. So that's the key. You can claim the benefit even though you got a loan, but once you apply for forgiveness and you're notified, you no longer are eligible for that.
Right. Thank you, Karen.
Mm-hmm.
So there were also provisions in the CARES Act for treatment of net operating losses, and Darko is going to talk about that for a few minutes. Darko?
Hi. Yeah, so just to give everybody an overview without reading through the slides, is that before the new tax law, even before the CARES Act, the new tax law under Tax Cuts and Jobs Act in 2017, the annual rules were as follows. Any net operating loss arising in a given year has to be carried back 2 years and then carry forward indefinitely. Starting January 1, 2018, the rules changed. The carryback period was eliminated, so no longer can you carry back NOLs. And then the carry forward period became indefinite. I apologize, the carry period for the previous, under the previous tax law was 20 years. So now there's no carryback, but the carry forward was 20 years. I mean, indefinitely. In addition to that, any net operating losses arising in 2018 and beyond were limited to 80% of the taxable income for that current year for any corporation. Now, with the CARES Act, a number of things happened. The government allowed for any tax years where net operating losses arise in years 2018, 2019, and 2020. The 80% limitation has been lifted all the way up to tax year 2021. In addition, they allowed for a 5-year carryback period. Why is this important? The 5-year carryback period can take us, if we're in tax year 2018, can take us back to 2013. What that means is that 2013, our tax rates were at 35%, whereas today our tax rates are 21%. So that rate differential may be very beneficial for some of for some taxpayers. And these provisions apply to both corporate and individual taxpayers and trusts. Next slide, please. So in order to, whenever an NOL happens in a given year, a carryback provision is mandatory. So we're in tax year 2019. If we have a net operating loss, we're required to carry back the tax year 2013. If that is not something that a corporation is beneficial to a corporation, the corporation has to make an election to not carry back the net operating loss. That is usually a statement attached to the tax return or a box checked. What happens if we've already filed the 18 and 19 returns? Well, there's a number of issues that can happen. We either file a superseded or an amended return, and we file an election to not carry back with that return. If it's already filed and there's an NOL, the government will likely presume that we need to carry it back. And the way we carry back or apply for a refund is there's 2 general options. One is an amended return, which is signified by the X at the end of the form. So 1120X is the corporate amended tax return, 1040X is the individual income tax return, amended returns. Or, which is kind of a preferred method, is the application for tentative refund. For corporations, that's Form 1139, and for individuals, that's Form 1045. We're going to focus on Form 1139 because we're talking most about corporations, but this is a preferred choice because the IRS must review this Form 1139 application for a refund, for a tentative refund, and issue a refund within 90 days. When filing a amended tax return, the IRS does not have these time requirements. And then the other timing issue that we have is that the tentative refund has to be filed within 12 months of the end of the tax year in which the NOL occurs. Like I said, the 1120X, the amended tax return Form 1120X takes longer to process, but it is final. And the other requirement here is that it must be filed within 3 years after a return in which the NOL arose is due or filed, whichever is later. Next slide, please. And I think that's it about our net operating losses.
Yep. Thank you, Darko. I know we were all a little bit rushed here at the end. Just so the key with the net operating losses is businesses may find a source of cash from losses to carry back that they didn't otherwise know. And number 2, it's really important when you're filing your current returns to really think about what you want to do to make that election to carry back or forego the carryback. 2 remaining topics we're going to address really quickly, then we'll wrap it up on interest expense and depreciation. And Karen, I think you're speaking about this.
Yep. So the interest expense, so under current law, business interest expense is limited to 30% of adjusted taxable income. So businesses with interest expense have to go through this calculation unless they are considered a small business taxpayer. meaning you have gross revenues, average gross revenues of less than $26 million. So assuming that your gross revenues exceed that amount, you can only deduct interest expense to the extent that it exceeds 30% of adjusted taxable income, which is essentially the equivalent of EBITDA, earnings before interest, taxes, and depreciation. The CARES Act temporarily and retroactively increased that limitation to 50%. This is a temporary increase. It applies only to tax years 2019 and 2020. And, you know, there are probably some businesses out there that have already filed their 2019 returns, and you do have the opportunity to amend to, you know, assuming that you were subject to a limitation. Just keep in mind, however, if you are a partnership, there are a bunch of very technical you know, complications related to this provision, and this temporary increase does not apply to you for 2019. Further, you can elect out. There are some situations where this increased limitation, you might not want to take advantage of it. So again, there's you know, some pretty technical rules here, but you know, the takeaway is that if you are subject to this overall limitation, you might want to, you know, revisit, you know, filing an amended return if you've already filed. And then the last thing that I want to talk about is depreciation. So when the Tax Cuts and Jobs Act was passed, it seems like an eternity ago already, there was a technical glitch in it where certain qualified improvement property ended up not having a favorable depreciable life. So their prior law before TCJA, qualified improvement property was categorized as 15-year property, which meant that it was eligible for bonus depreciation, which is, you know, the accelerated, you can write off 100% of the cost of qualified, you know, property placed in service. So we've been waiting for several years for this glitch to be fixed. And finally, as part of the CARES Act, this technical correction has been made. So qualified improvement property is now treated as 15-year property, and it is now eligible for bonus depreciation. And this change is retroactive back to 2017. So, you know, we've already filed 2018 and possibly 2019 tax returns. So we do have the ability to correct this and almost make like a catch-up adjustment if we needed to. And we could do that either through an amended return, as Darko had kind of mentioned what the procedure is, or if we don't want to go back and amend a previously filed return, there is the ability to file for a change in accounting method, which would require a Form 3115 be attached to your current year return, and then you can make this catch-up adjustment and put yourself in a position as if you had always, you know, intended to claim bonus depreciation on this type of property. And that's about it, as fast as I can.
Yep, and just another source of free cash flow for businesses that did have those assets placed in service. So I know we ran a few minutes over. I do apologize for keeping everybody. On behalf of Bill, Karen, and Darko, we at Welcome to Company Plan do appreciate you taking the time to share with us about the CARES Act. We are available to answer any questions. You will have our information on the webpage. Again, thank you, and we hope everybody stays safe and is healthy. Thank you.